Imagine sitting down on your 18th birthday and signing a legal contract that dictates the trajectory of your finances for the next 3 decades. At this point in your life, you probably haven't signed a lease for an apartment. You likely haven't earned your first full-time paycheck. Yet, you are legally cleared to borrow tens of thousands of dollars. For generations, society delivered a single, unbending instruction: get a degree, and a better life will follow. Higher education was framed as a mandatory rite of passage, rather than a calculated financial decision. The underlying math seemed invisible. The cultural assumption held that a university diploma would generate a high enough salary to pay off whatever debt was required to earn it. Because an education was universally treated as an inherent social good, millions of young adults absorbed a lifelong debt obligation without examining the specific terms. Then, the math broke. The price tags on universities aggressively detached from the standard rate of inflation. This chart compares the rising cost of higher education against standard economic inflation. You can see how public universities, private colleges, and basic living expenses all spiked simultaneously, leaving regular wages far behind. Instead of adjusting expectations, families replaced their depleted savings with easy-to-access student credit. The volume of borrowing climbed right alongside the tuition hikes. Taking out maximum loan amounts each semester transitioned from a careful last resort into a routine annual checklist item for students across the country. The result of that normalized behavior is visible in the raw data. The total U.S. student loan balance ballooned until it hit a record-breaking $2 trillion. That number is the direct consequence of a collision. Unwavering faith in the power of a degree met soaring costs and frictionless access to credit, turning an intended investment into a generational debt trap. $2 trillion is difficult to visualize. The reality is lived at the individual level, where student loans act as a severe restriction on personal flexibility. When hundreds of dollars are deducted from your bank account every month, traditional adult milestones are pushed back. The most immediate casualty is homeownership, as saving for a down payment becomes mathematically impossible for many young professionals. This pressure alters how people navigate their careers. Graduates frequently bypass entrepreneurial risks or jobs they actually care about, forced instead to prioritize roles that offer immediate, stable income to service their loans. Over time, this creates a chronic psychological weight. It is the constant, low-level stress of knowing that before you even deposit your paycheck, a significant portion of it already belongs to a servicer. That single signature at age 18 quietly rewrites the timeline of a person's life, routinely pushing financial stability and personal independence deep into their 30s or 40s. When millions of individuals delay these financial milestones at once, the aggregate effects ripple through the entire national economy. This flow system shows how capital moves in an economy weighed down by student loans. Billions of dollars are siphoned away from real estate markets, retail spending, and small business startups, pouring straight into a debt servicing sink. Over decades, this dynamic fractures the economy along demographic lines. We see a widening wealth gap separating older generations who hold appreciating assets from younger adults carrying depreciating loan balances. Ultimately, this debt burden acts as an anchor. When a generation can't buy homes or start companies, the local contractors, retail workers, and service providers see their own opportunities vanish. It is a systemic slowdown that reaches those who never stepped foot on a college campus. This requires a nuanced look at the universities themselves. Higher education is a rigorous, necessary environment, and for many fields, a degree remains an absolute requirement. Doctors, engineers, and researchers require intensive training. For these technical paths, graduates consistently see lifelong financial returns that far outweigh their initial borrowing. The root issue is a practice we can call blind borrowing. This is the act of signing for a loan without running a realistic analysis of the future median earnings for that specific degree. To navigate the modern economy, families have to drop the assumption that college is a cultural guarantee. It must be evaluated as a strict, localized financial calculation. Education retains value. However, its true worth is only realized when the total cost of borrowing is meticulously weighed against the long-term economic return it provides. For the incoming generation of adults, the defensive playbook is clear: aggressively research your career's return on investment, leverage community colleges, and actively seek out employers willing to fund your continued education. When you inevitably face the financial aid paperwork, the most important tactical choice is restraint. Avoid maximizing your offered loan limits and borrow strictly what you need to cover your essential costs. The history of the student debt crisis shows that a few strokes of a pen can dictate the growth of the national housing market, the success rate of new startups, and the family planning of millions. For an entire demographic, the most consequential financial decision of their lives happened years before they earned their first real paycheck. Cut to black. Next on The Explainer, why housing became unaffordable for an entire generation.